You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive, where we take your sources and really try to extract the most important insights. Today we're doing a deep dive into this really powerful force, something that can derail even the most careful, well-intentioned investors. FOMO, the fear of missing out. Specifically, how it plays out and often sabotages your investing journey. If you've ever felt that sort of gut-wrenching anxiety watching a stock just skyrocket, or maybe you've impulsively jumped into something because, everyone else was doing it, well, this deep dive is definitely for you. We're going to peel back the layers of the psychology behind it, expose the real dangers, and maybe most importantly, help you build the mental fortitude to tune out all that noise and stay on track.
Yeah, what's really fascinating here is just how universal this emotion is. I mean, we all feel it. But it gets uniquely amplified, almost distorted in the investment world, and often becomes quite destructive. We'll be looking at the psychology that really underlies this and why it becomes such a damaging pattern for so many people.
Okay, let's dive right into this then. We actually have a story to kick us off that I think perfectly illustrates this whole FOMO epidemic. Let's look at Sarah. She's, let's say, a 28-year-old marketing professional back in early 2021, a familiar time for this kind of thing. She saw her coworkers, almost boasting about their GameStop gains. One claimed they made $15,000 in like 3 days. Another doubled their money on Dogecoin. And Sarah, she said she felt physically ill, just thinking everyone else is getting rich and I'm stuck here with my, my boring index funds.
Right, and that raises such an important question. When you feel that kind of intense social pressure, that perceived missed opportunity, what's the immediate reaction? What did Sarah do next? Because that emotional response is key.
Well, Sarah did exactly what probably millions of others did right then. She liquidated half her retirement savings, money set aside for, decades down the line, and she jumped right into those hot stocks and cryptocurrencies everyone was talking about. Within 6 months, just 6 months, she'd lost 60% of that money. Poof. The very FOMO that promised these quick riches. It ended up costing her years of really disciplined saving. And this isn't like a unique story, right? It's FOMO investing playing out globally again and again. So if that's the kind of painful outcome we can see, what exactly is FOMO investing? How do we define it?
Well, at its core, it's making investment decisions based primarily on that fear of missing out on potential gains. It's not based on solid research or careful risk assessment, or even whether it aligns with your own long-term goals. It's kind of like, imagine you're at a restaurant, right? The table next to you gets this amazing-looking dish, so you immediately order it without even checking if you like the ingredients or if it fits, your diet or anything. You're just reacting to how good it looks over there, not your own plan.
That's a great analogy. It really hammers home the personal risk involved, ignoring your own needs. So, okay, where does it get really interesting? What are the key characteristics, the telltale signs that define it?
Yeah, we see several patterns pretty consistently. First, it's almost always driven by emotional decision-making, anxiety, envy, that real fear of being left behind, not facts, not analysis. Second, there's this intense short-term focus. People get obsessed with quick gains, immediate gratification. They completely lose sight of long-term wealth building.
So it's that instant gratification trap. We see it everywhere now, but it's amplified in finance.
Exactly. Then you've got the herd mentality. Just following the crowd, buying whatever's hot without any independent thought. Everyone's doing it, so it must be right. Which naturally leads to reactive behavior. You're just reacting to market movements, social media buzz, instead of sticking to a proactive strategy. And finally, there's selective information processing. Our brains are brilliant at this, unfortunately. Seeking out only the info that confirms your desire to buy, while conveniently ignoring or explaining away all the risks.
That selective processing one is, it's insidious, isn't it? We literally filter out the warnings.
Yeah.
Okay, so to really get why FOMO investing is so powerful and so destructive, we need to dig into the human psychology, because it's not just about investing, right? It's a fundamental human thing, just turbocharged by our hyper-connected world.
Absolutely. And if we connect this to the bigger picture, it really stems from some deep-seated biases, things that are kind of hardwired into us. Take the social comparison trap. We are built to compare ourselves to others. It's how we gauged our standing historically. But back then, it was just your small circle, your village maybe. Today, social media throws thousands of financial highlight reels at us, every single day. We see the Bitcoin millionaires, the lucky stock pickers. We don't see the vast majority who lost money. So it totally distorts our perception of what normal investment success even looks like. You're only seeing the shiny tip of the iceberg.
Right. So it's not just seeing success, it's seeing this curated, often misleading version that makes us feel inadequate or behind. That's a huge difference from, comparing yourself to your neighbor 100 years ago.
A massive difference. And another big one is loss aversion and regret. Behavioral economics shows this clearly. We feel the pain of losses much more intensely, maybe twice as intensely, as the pleasure of equivalent gains. In investing, this often twists into fearing the regret of missing out on gains, even more than fearing the regret from actual losses. So if a stock you thought about buying goes up 50% and you didn't buy, that I should have feeling can sometimes sting more than actually buying a stock that then drops 50%. The what if can be incredibly powerful.
Wow. That's a really profound point. It's the missed opportunity, this sort of phantom gain that gets under our skin. It makes perfect sense why that would drive impulsive buying.
It does. And this ties into the availability heuristic. Our brains use mental shortcuts, right? We judge how likely something is by how easily we can recall examples. So back in 2021, those stories of crypto millionaires, they were vivid, they were everywhere, constantly repeated. It made quick riches seem way more probable than the frankly boring reality that most people speculating were losing. And finally, we really can't ignore the gamification of investing. These modern apps, they often amplify FOMO by design, push notifications, little confetti explosions when you trade, leaderboards comparing your returns. It's all engineered to keep you engaged, sure, but also focused on short-term performance and social comparison. It pulls you away from that patient long-term wealth building.
Yeah, the confetti, while your long-term plan is maybe going up in smoke. Okay, so while the media loves the big wins and losses, the real damage of FOMO investing is often, as you said, more subtle, more widespread. What does this really mean for your wallet and maybe just as importantly, your well-being?
The costs are significant, and they compound in ways people often don't see coming. Let's start with the obvious one. Opportunity cost. Every single dollar you lose chasing FOMO is a dollar that could have been working for you, growing steadily. Remember Sarah, that $30,000 she lost? If she just left it in her boring index funds earning, say, 7% a year, it could have grown to over $230,000 by retirement. So FOMO didn't just cost her $30K now, it potentially cost her nearly $250,000 in future wealth.
Wow, that's staggering when you frame it like that. It's not just the loss today, it's the future you gave up. It really is like stealing from your future self.
Exactly that. Then there are the often invisible transaction costs. Frequent trading, even on commission-free platforms, isn't actually free. You still pay bid-ask spreads, you face market impact. This can easily eat away 1%, maybe 2% of your portfolio value every year, just quietly eroding your returns. It adds up massively over time. And don't forget tax inefficiency. Churning your portfolio usually triggers higher short-term capital gains taxes. For many people, that's up near 37%. Compare that to the lower long-term rates, maybe 15–20% for patient investors who just buy and hold. Over decades, that tax difference alone can cost you hundreds of thousands in wealth.
So it really is death by a thousand cuts. Little bits draining away from different angles, all because you're chasing instead of planning. But you also mentioned well-being.
Yes, and this is perhaps the most underestimated cost. The emotional toll. The constant anxiety, the stress of making frequent decisions, the shame when things go wrong, that whole roller coaster of hope and disappointment takes a huge toll on mental health, on relationships even. Many FOMO investors get this unhealthy obsession, constantly checking their portfolio, letting market blips dictate their entire mood. It's just exhausting.
Yeah, that obsessive checking, feeling your stomach drop with every little dip. I think a lot of people can relate to that. Okay, so understanding where all this noise, this pressure comes from seems crucial for defending against it. Where are these powerful sources of investment noise really originating?
Well, we can pinpoint several key players, and it's really important to understand their incentives, why they create this noise. First, you have the financial media. It operates 247, right? It needs constant content. This creates an inherent bias towards action, towards drama. Think about headlines. Market soars, or crash warning. Those get clicks. Markets continue slow, steady growth. Not so much. So they focus on the extreme winners, the extreme losers, because it's just more engaging than telling the story of steady, boring success.
So it's basically designed to grab your attention, maybe even trigger that anxiety, rather than actually help you with a long-term strategy. Makes sense.
Precisely. Then a huge factor now is social media and influencers. This has, democratized financial advice, which is both good and sometimes really, really bad. Influencers, or finfluencers, they're often rewarded for engagement, for going viral, not necessarily for the quality or soundness of their advice. Controversial takes, get-rich-quick schemes, those get more followers, more likes. It's just how the algorithm works. And critically, many have undisclosed conflicts of interest. They might be promoting stocks they already own or getting paid by platforms to push certain products. You have to ask, how does this person make money, and how might that be influencing the advice they're giving me?
That's such a critical question. It's so easy to overlook when you're caught up in the hype and someone seems relatable or successful.
Absolutely. And sometimes, honestly, the most powerful FOMO comes from your own social circle. Friends, coworkers, family members bragging about their gains. It can be incredibly persuasive. But just remember, people naturally share their wins way more than their losses. For every person boasting about a big score, there are probably several others who quietly lost money but aren't exactly shouting about it. And, ironically, even your own past experiences can trigger FOMO. If you missed out on a big winner before, maybe you hesitated on buying Tesla early or something, that painful memory can make you jump into the next hot thing without proper analysis. That's recency bias, giving too much weight to your recent vivid experiences.
Right, so you're trying to make up for the last mistake, potentially making an even bigger one. Okay, so we've dug into what FOMO investing is, why it's so destructive, where the noise comes from. The big question now is how do we actually defend against it? Because it seems like it's not about just suppressing these very human emotions, that sounds impossible, but more about creating systems, right? Frameworks to help us make rational decisions even when those emotions are screaming at us.
Exactly. It's about building practical, robust frameworks. And the absolute foundation, step one, is to develop a written investment plan. You create this plan when markets are calm, when you're thinking clearly, not in the heat of the moment. It needs to include your specific financial goals with timelines, like $500,000 for retirement by age 60. Your honest risk tolerance. What can you actually stomach without panicking? Your target asset allocation percentages for stocks, bonds, etc. Also, your investment selection criteria. What kinds of things will you invest in? What will you specifically avoid? And your rebalancing schedule. Then when FOMO strikes, when that shiny object appears, you pull out this plan and ask, does this actually align with my strategy, or is this just my emotions talking?
So it's like a pre-commitment, a contract with your future self, written when you were rational to guide your emotional self later. I like that.
Precisely. It's your anchor. Step two is incredibly powerful. Automate your investments. Just remove yourself from the day-to-day decision loop as much as possible. Set up automatic, recurring investments into diversified, low-cost index funds. This automatically implements dollar-cost averaging you buy consistently, regardless of market highs or lows. It smooths out volatility, and crucially, it removes that constant temptation to tinker or time the market.
That's brilliant. It takes the emotion almost completely out of the equation for your core saving strategy. Just let it run.
It does. Step three, create information boundaries. FOMO thrives on overload, on constant exposure to triggers. So consciously limit your financial news consumption. Maybe just check in once a week, not multiple times a day. Unfollow social media accounts that you know trigger that FOMO feeling in you. Be ruthless about it. Set specific, infrequent times for checking your portfolio, maybe monthly or even quarterly. Definitely not daily. Hourly checking is poison. And be selective about the content you do consume. Focus on genuine financial education, things that build understanding, not just hype.
So it's about actively curating your environment to protect your mindset, like putting up a mental firewall against all that noise.
Exactly right. And step four, develop a decision-making framework for when those opportunities inevitably pop up, because they will. First, maybe implement the 48-hour rule. Never make an immediate decision on something that feels like FOMO. If it's a truly good, sound opportunity, it will still be there in 2 days. High-pressure tactics are a red flag. Next, try the explanation test. Can you explain this investment, what it is, why it's a good fit for your specific goals and portfolio, and what the real risks are? Can you explain that clearly and simply to a reasonably smart friend? If you can't articulate it, you probably shouldn't buy it. Then consider the portfolio impact test. How does this single, potentially speculative investment affect your overall asset allocation? Does it significantly increase your risk concentration in one area? Does it throw your carefully crafted plan off balance? And finally, maybe the toughest one, the regret minimization test. Really force yourself to imagine 2 scenarios. Scenario A, you buy this thing and it goes to 0, complete loss. Scenario B, you don't buy it and it goes up 500%. You miss out big time.
Which regret would genuinely be worse for you, financially and emotionally? If losing the money would be more painful than missing the potential gain, that tells you something important.
Wow, that last one. That really forces you to confront your true risk tolerance, doesn't it? And it probably takes some courage to admit that missing out might actually be the less painful option sometimes.
It absolutely does. It requires real honesty with yourself. And finally, step 5, which is so often overlooked but so important, practice gratitude and perspective. FOMO is inherently about focusing on what you don't have, what you perceive you're missing. So consciously, regularly practice gratitude for your current financial situation, whatever it may be. Acknowledge the progress you have made. And remember, wealth building is a marathon. It's not a sprint. Consistent saving and patient investing, letting compounding do its work, that's the real key, not hitting home runs every week.
Okay, let's make this even more concrete. Let's look at some real-world historical examples where FOMO clearly played a starring role, illustrating these principles and the painful consequences of ignoring them.
Yeah, looking back at financial history, these patterns just repeat themselves. It's almost predictable. Think about the dot-com bubble back in 2000. Late 90s, internet stocks were soaring to insane valuations, often with zero profits, sometimes not even revenue. Investors just abandoned all discipline, chasing these parabolic gains, terrified of missing out on the new economy. When the bubble inevitably burst, the NASDAQ crashed, 78%? Many individual stocks lost 95% of their value or disappeared completely. Now, the people who avoided that FOMO, who stuck to their diversified, maybe boring portfolios, they missed the crazy speculative run-up, sure, but they also avoided catastrophic losses and were well-positioned to benefit from the long-term market growth that eventually followed.
A classic case of chasing the shiny new thing, fueled by collective euphoria and the fear of being left behind in the old economy.
Indeed. And we saw a remarkably similar narrative play out with the cryptocurrency mania, both in 2017 and then again even bigger in 2021. Bitcoin, other cryptos, saw these truly historic price surges, grabbing headlines everywhere. Huge numbers of people bought in, driven almost purely by FOMO, wanting those quick, life-changing gains, often without really understanding the underlying technology, the intense volatility, or the very real risks involved. And both of those manias were followed by brutal crashes. Bitcoin dropped over 80% after the 2017 peak and over 70% after the 2021 peak. The FOMO investors, they often bought near the top, fueled by the hype, and then panic sold near the bottom, locking in massive losses. The lesson isn't really about crypto itself, good or bad, but about the extreme danger of jumping into any asset class during peak hype and peak FOMO.
And then there's the more recent, very public example, the meme stock phenomenon in 2021, GameStop, AMC. That was incredible to watch. That seemed driven not just by profit potential, but also this sense of being part of a social movement, right? Retail investors coordinating on Reddit, taking on the hedge funds.
Precisely. It had that extra layer. Many people bought not because they thought GameStop was fundamentally worth hundreds of dollars a share, but for the excitement, the community, the narrative. But when that initial euphoria faded, as it always does, the prices crashed spectacularly, leaving those who bought late purely on FOMO holding very heavy bags. It just perfectly illustrates how modern tools like social media and the power of groupthink can amplify FOMO to just dizzying and ultimately very destructive levels.
It really highlights how emotion and narrative can completely overwhelm fundamentals in the short term.
Yeah.
Okay, so one of the most important lessons here, and maybe the hardest one to internalize, is embracing the power of, well, boring, consistent investing. Because the reality is, the most successful long-term investors usually aren't the ones making headlines every week. They're quietly, almost invisibly, building wealth.
Yeah, and this raises that crucial question. What is it about boring that makes it so incredibly powerful in investing? A huge part of it is the magic of compound interest. Einstein supposedly called it the eighth wonder of the world, right? It's that simple yet profound process of your money earning returns, and then those returns earning their own returns. It snowballs. You invest, say, $10,000. At 7% a year for 30 years, it grows to about $76,000. That's $66,000 in growth, most of it from compounding. But the real magic, or maybe the real challenge, is that it requires time and consistency. It requires resisting the urge to constantly change strategies, to chase hot stocks, to interrupt that quiet compounding process. Our instincts fight against it.
It's the ultimate test of patience, isn't it? Just letting that slow, steady, almost invisible growth happen over decades, resisting the urge to do something.
Exactly. And this leads directly to the beauty of index fund investing. Index funds are, let's be honest, probably the most boring investment vehicle imaginable. They don't try to be clever. They just buy and hold all the stocks in a broad market index like the S&P 500 or Total World Stock Index. There's no star manager trying to pick winners. The fees are incredibly low because there's little management involved. They're tax efficient because they don't trade much. And crucially, they demand almost no emotional decisions from you. And study after study shows this boring approach consistently outperforms the vast majority of actively managed funds over the long run, precisely because it avoids costly mistakes and keeps fees low. It also massively reduces your temptation to tinker.
It really is the ultimate set it and forget it strategy for most people's core portfolio, isn't it? What about the actual people who embody this, who are the successful, boring investors?
Well, the classic example is Warren Buffett. He built arguably the greatest investment track record in history through patient, long-term investing in businesses he understood, bought at reasonable prices, and held for decades. He's famously not chasing crypto, not jumping on the latest tech fad. He's holding companies like Coca-Cola or American Express for decades, letting them compound. Or think about Jack Bogle, the founder of Vanguard. He basically invented the index fund for individual investors. His entire philosophy, which made him wealthy too, was built on that boring strategy. Buy the entire market, hold it forever, and keep your costs as low as humanly possible. They succeeded because they were boring, disciplined, and avoided the emotional roller coaster that derails so many others.
Okay, so knowing the theory is one thing. We get it. Be boring, be patient, have a plan. But how do you actually implement this FOMO defense in your daily life? When that feeling strikes, and it will, what are some really practical tools you can grab?
All right, let's get hands-on. Here are some strategies that can really help in the moment. First, try keeping the investment journal. When you feel that powerful urge to buy something purely out of FOMO, actually take a minute and write down why you want to buy it. What you really hope to achieve? What are the actual risks you can identify? Often, just the act of writing it down forces you to confront the emotional reasoning versus any rational basis. Here's a key addition. Also use the journal to record the times you successfully avoided a FOMO investment that later turned out badly. This reinforces that positive behavior, proving to yourself that resisting the urge was the right call.
Oh, I love that idea. Journaling not just your actions or mistakes, but your successful inactions, your successful resistances. That's a great way to build confidence in your discipline.
It really is. Positive reinforcement for good behavior. Next, use the opportunity cost calculator. Before you pull the trigger on that speculative FOMO buy, take 5 minutes and actually calculate what that same amount of money could realistically become if you just added it to your boring, long-term diversified portfolio. For example, putting $5,000 into some hot meme stock versus seeing that $5,000 potentially grow to, say, $19,000 or $20,000 over 20 years in your index funds at a reasonable 7% return. Visualizing that future difference, the true cost of that speculation, can be a powerful deterrent. Also, actively cultivate the support system. Find friends, family members, maybe a partner, who genuinely share your long-term disciplined investment philosophy. Having someone you can call, someone who gets it, who can talk you down when that FOMO feeling is overwhelming, can be absolutely invaluable. Or consider joining online communities like the Bogleheads Forum, places explicitly focused on low-cost index fund investing and maintaining discipline through market noise.
Yeah, surrounding yourself with the right influences, people who reinforce the right behaviors instead of amplifying the hype, that seems crucial, especially when your own brain chemistry is working against you sometimes.
Absolutely crucial.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
And finally, apply the stress test. Before you make any investment that feels even slightly speculative or FOMO-driven, honestly imagine the worst-case scenario. If this investment went completely to zero, how would it really affect your life? Would you lose sleep over it? Would it jeopardize your ability to retire on time? Or is it truly money you can afford to lose without any major consequences? Only take risks, especially speculative ones, that you can genuinely afford to absorb, both financially and emotionally.
That's a really sobering but necessary check. Okay, so taking all these strategies and defenses into account, what does a genuinely FOMO-resistant portfolio look like in practice? It sounds like it's designed for long-term wealth accumulation, definitely not for short-term excitement or bragging rights.
Exactly. It's about structure, discipline, and diversification. The vast majority, let's say 80% to 90%, should be your core holdings. This is the bedrock, the foundation of your long-term wealth. It should consist primarily of broad, diversified, low-cost index funds. Think a total U.S. stock market index fund, giving you exposure to thousands of companies, big and small. An international stock index fund for exposure to developed and emerging markets outside the U.S. And a broad bond index fund for stability, income, and diversification from stocks. These are inherently boring, yes, but together they provide incredibly broad diversification and low-cost exposure to overall global economic growth.
So that's your quiet workhorse, the engine just reliably chugging along doing its job regardless of the daily market drama or headlines.
Precisely. Then you might allocate a smaller portion, say 10% to 20%, to satellite holdings. These can provide some additional diversification or allow you to express a slight strategic tilt, but, and this is key, they should always be deliberate, well-researched additions, not impulsive FOMO buys. Examples might include index funds focused on small-cap stocks or value stocks, maybe some real estate investment trusts, REITs, for property exposure, or perhaps a tiny allocation to commodities or precious metals if it fits your overall strategy. The point is, they complement your core holdings. They don't compete with them or contradict your overall long-term plan. And finally, if you absolutely, positively feel you must scratch that speculation itch, and for some people that urge is strong, then set aside a very small speculation account, maybe 5% or less of your investable assets. This is play money. Money you can genuinely, truly afford to lose completely without impacting your serious financial goals. Use this account for trying out individual stocks, maybe a tiny bit of crypto, or whatever other highly speculative thing catches your eye. But think of it strictly as entertainment, like going to Vegas, not as serious investing. And critically, never let wins or losses in this tiny account influence the strategy for your core 80–90%.
That entertainment versus investing distinction for the play money is really important, setting those boundaries. Okay, ironically, it seems like the same technology that often fuels FOMO, the apps, the constant information, can potentially also be used to help manage it. Are there tech tools that can actually assist in building this defense system?
Yes. Thankfully, there are some practical applications on the tech side as well. Some investment apps now offer restrictions. You might find platforms that allow you to enable cooling off periods, like forcing you to wait 24 or 48 hours before a trade executes after you place it. Some might allow you to set limits on how much you can invest in certain types of speculative assets. Explore those settings. Automated rebalancing features are becoming more common. Robo-advisors are built around this, but even traditional brokers might offer tools that automatically adjust your portfolio back to your target asset allocation periodically. This removes the temptation for you to tinker based on what's gone up or down recently. When choosing portfolio tracking apps, consciously opt for ones that emphasize your long-term progress towards your actual financial goals, rather than just showing you flashy daily percentage gains and losses, which can feed anxiety and FOMO. And yes, don't underestimate using basic social media filters or even dedicated website app blockers. You can literally block access to financial news sites or certain social media platforms during times you're feeling particularly vulnerable to FOMO triggers.
That's smart. Using tech to build guardrails against tech's own temptations sometimes. Now, for some people, managing FOMO might be something they can tackle alone using these strategies, but for others, professional help could be really invaluable. When does it actually make sense to consider seeking out a professional financial advisor?
Yeah, this is a really important question for many listeners. When should you seriously think about bringing in an advisor? Certainly, if you have substantial assets or a particularly complex financial situation, maybe you own a business, have multiple properties, intricate estate planning needs, complex tax situations, an advisor can be essential just for managing that complexity. But more directly related to our topic today, if you find you consistently struggle with making emotional investing decisions, despite really trying your best to implement these kinds of strategies we've discussed, then professional guidance could be key. A good advisor can act as that crucial behavioral coach, helping to guide you through those emotionally charged market moments, reminding you of your plan, keeping you grounded. And of course, if you need help creating a comprehensive financial plan that goes beyond just investing, looking at insurance, debt management, retirement projections, estate planning, then an advisor is invaluable for that holistic view. Just make sure when choosing one, you look for fiduciary, someone legally obligated to act solely in your best interest. Check for transparent fees. Fee only is often preferred. And ensure their investment philosophy actually aligns with the long-term, diversified, low-cost approach we've been talking about. Avoid advisors who seem eager to push complex products or encourage frequent trading.
Great advice on choosing the right help. Okay, as we start to wrap up this deep dive, the big takeaway seems to be that overcoming FOMO investing isn't really about trying to suppress your emotions because, let's face it, that's nearly impossible. It's much more about creating those robust systems, those frameworks, those guardrails that allow you to make rational, disciplined decisions even when those powerful emotions are running high. The path to building real long-term wealth. It isn't flashy, it probably won't make exciting dinner party conversation. It's about consistently saving money, investing that money in broadly diversified, low-cost portfolios, and then patiently letting compound interest work its quiet magic over decades. It's fundamentally about learning to consciously tune out all that noise and staying relentlessly focused on your own personal long-term goals.
Absolutely. And think back to Sarah from our opening story. Remember, 6 months after that FOMO investing disaster where she lost 60%, she made a really pivotal decision. Instead of doing what many people do, trying to chase the next hot thing to desperately recover those losses, which usually just digs the hole deeper, she committed to going back to the foundational basics. She worked with an advisor, created that written investment plan we talked about. She automated her regular investments into diversified index funds, and she made a hard commitment to only checking her accounts once a month. That's it. Fast forward 5 years. Her portfolio hadn't just recovered all its losses, it had grown substantially beyond where it started. But maybe more importantly, she said she sleeps better at night. She's no longer consumed by that constant anxiety, no longer worried about missing the next big thing. She knows she's playing the long game now, her own game.
That's the real win right there, isn't it? That peace of mind, knowing you're on a sustainable path. Look, the financial media, the social media influencers, even your well-meaning friends, they're going to continue presenting opportunities, often designed, consciously or not, specifically to trigger your FOMO. It's how they get attention. Your job as an informed, disciplined investor is to consciously tune out that noise, learn to recognize it for what it is, and focus steadfastly on what truly matters for your future. Consistent savings, sensible investing, and patient long-term wealth building.
So let's quickly recap the key takeaways from this deep dive. First, FOMO investing is driven by those powerful, deep-seated psychological biases, social comparison, loss aversion, massively amplified by our modern, hyper-connected world. Understanding these biases in yourself is the crucial first step to defending against them. Second, the real cost of FOMO isn't just the money you might lose on a bad speculative bet. It's the staggering opportunity cost of abandoning your disciplined, long-term wealth-building strategy. It's the future wealth you never get the chance to build. Third, building a robust FOMO defense system requires tangible things: a written plan, automating your core investments, creating strict information boundaries, and having a systematic decision-making framework for when temptation strikes. These are your practical guardrails. Fourth, remember that the most successful long-term investors are very often the most boring ones. They focus relentlessly on consistent, low-cost, diversified long-term strategies that harness the quiet but immense power of compound interest. Embrace the boring. And finally, if you find yourself consistently struggling to manage FOMO on your own, despite your best efforts, it is not a sign of failure to seek professional help. A qualified fiduciary financial advisor can be that invaluable behavioral coach to keep you on track.
So what does this all mean for you listening right now? It means your future self, the one counting on these investments decades from now, will profoundly thank you for the disciplined, maybe even boring decisions you make today. Even if those decisions sometimes feel like you're missing out on some fleeting excitement, some quick win everyone's talking about, just remember this core truth. In investing, boring usually wins. The tortoise really does beat the hare over the long run, and compound interest genuinely is the eighth wonder of the world, but only if you give it the time and the consistency and the patience it needs to work its magic for you.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.